Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about everything happening in the crypto markets, not investment advice, of course. And for those who prefer to read, you can always check out our blog on our website, ar.ca/blog, with the aptly named That's Our Two Satoshis blog. Don't have a guest this week. We've had some really good guests the last couple of weeks. Don't have one for this week. But what we were talking about, really, honestly, I kind of mailed in the writing this week. I was at a wedding, but I wanted to talk a lot about how these Middle East wars don't matter for markets. And I'm not trying to suggest that they don't matter, obviously, depending on where you live and your views, or even just any part of society. You never want to see this. But from a market standpoint, that's what I mean. We've been through this for so many decades now. The data is all the same. Even though oil was up slightly and gold was up slightly and treasuries were up slightly and stocks and crypto were down slightly, it's a familiar response to any kind of a Middle East war, but it doesn't last. It never does. These are knee-jerk, algo-driven responses. Whether you're talking about Bitcoin, the average Bitcoin drawdown during any of these geopolitical skirmishes have been anywhere from 7 to 8%, and it's all been fully retraced within 2 to 3 weeks. Or if you're talking more broadly, with global markets, similar type of data. Shout out to Jim Reed at Deutsche Bank, who had a really good table with about 30 different events over the last 75 years. Average the median time to recover is 16 days. The median size of the sell-off is 6%. The returns 1 week, 1 month, 3 months, 6 months, 12 months are all positive 3, 6, 7, 10, and 14%. So it's just another way of saying that markets like to trade. Markets are going to be markets, but these are just not reasons to have any sort of a change in long-term view in the actual digital asset market, or even really any global markets. What is more long-lasting, and I feel like a little bit of a broken record here because we've been talking about it for almost a decade now, and even more prominently in the last 6 to 12 months, but we really are evolving in the digital asset space away from these inflationary VC tokens that just have really no traction, but have a token probably way earlier than they need to, and as a result, they just kind of go straight down, right? I mean, you pick your Celestia or your Barachain or your Optimism or Arbitrum, I mean, you name it, right? Any of these layer 1, layer 2 protocols that have 3 to 10% annual inflation. And don't forget, inflation is very different than VC unlocks. They're both bad for markets, but VC unlocks are tokens that have already been sold, and then the tokens are locked up and the investors can't do anything with them until a certain period of time, and then they're allowed to sell them, and that puts new pressure on the market because of the float increasing of the token. But that really has nothing to do with the market cap. Whereas inflationary tokens, meaning these protocols that, whether it's proof of work, proof of stake, proof of something else, where you have to actually issue new tokens in order to make the network run, as the emissions are what create the rewards and the incentives to keep the network on the blockchain functioning. That's just daily or monthly sell pressure that comes for all of these blockchains that really there's just not enough demand to absorb it. I mean, even Bitcoin, it's actually more shocking that Bitcoin continues to go up than it is the other way around because of how much inflationary pressure there has been over the years on that token. I think that's the anomaly, not the norm, right? The norm is when you have these massive supply increases constantly, it's just really hard to find enough demand to offset that, all else equal. And the only thing that changes that is when you have a revenue producing company that is able to pour that revenue back into the market through buybacks, right? That's the natural anecdote to, or antidote rather. That's the natural antidote to constant selling, is having some sort of constant buy pressure. So we wrote about this week again, and I said some of these things before, we just sort of rewrote it in a different way. But, again, for something to have value, it has to have one of 3 forms. It has to have financial value, which is cash flows, utility value, which is, a usefulness of some sort, like airline miles, Starbucks points, tokens to pay gas, etc. Or it has to have some sort of social value. And the reality is what we're finding out this year is that all of the ones that only have social value are just getting smushed because there's too many tokens and there's too much sell pressure. It's only the ones that have true financial value, revenues and cash flows, or real utility value, meaning some sort of demand sink because it's useful, that have had any real sustainability. And that can change. I mean, I've been on record saying alt season is dead. We'll never see something like that again. Some disagree with me. I don't know what will ultimately happen here, but just every single week, over and over again now, we're just seeing the money is flowing into the tokens that have real businesses. And I just don't think that's going to change. But what will change as a result of this is you're just going to have a continued quiet rise of financial value investing. Some of us who come from the TradFi world have been talking about this for years, often getting laughed at because the majority said that you're never going to be able to value tokens. But quietly and aggressively, I guess we're seeing the markets sort of take that to heart in 2025. And we're just seeing more and more of this financial value investing, which what that does is that's going to start to give confidence to new investors to come into the market because these are the things that they understand, right? So the shift toward value investing is more than just a change in asset selection. It's really a signal that digital assets are maturing. And it forces teams to think beyond token launches and incentive programs. It encourages the development of sustainable business models, foster long-term planning, promotes alignment between investors and users. It also encourages teams to engage with liquid fund managers and large crypto native retail investors rather than just the venture capitalists. I mean, I can tell you, at Arca now, we're getting calls and emails constantly now from teams that are asking us to help them think through token structures and tokenomics, and to think through like how do they actually engage investors more through some sort of IR functionality. And this opens the door to institutional capital, right? Pension funds, endowments, sovereign wealths, they're not going to chase meme coins, but they are increasingly focused on assets that generate yield, cash flows, and governance rights, and have IR teams and things that they're used to. So I do think that we're probably seeing this maturation process in progress in real time right now. And you're seeing it in the price action of tokens pretty much every week at this point. And I think that's a good thing, right? Not necessarily for tokens that people own that don't fit these criteria, but it is a good thing for overall markets. And it'll be interesting to see if the exchanges respond as well. You look down the list of the things that most of the biggest exchanges list and prioritize from a trading standpoint. And it's a collection of garbage for the most part, right? They focused more on just having things trade for the sake of trading rather than promoting actual good projects and good assets. So now that we're seeing the price action almost exclusively benefiting the better projects, they might have to morph their business models as well. So we'll see what happens. Obviously, this stuff can change on a dime. Last week, a good example, a majority of the market was down anywhere from 20 to 30%, with the exception of the handful of companies that we mentioned. And so it's exhausting saying the same thing over and over again, but it's Maple, with the token Syrup. It's Bitfinex's Leo token. It's Jito, Hyperliquid, Maker, BNB, Bitcoin, you name it. Like it's the same names over and over again that are outperforming on a week-over-week basis, and they all share pretty similar characteristics with the exception of Bitcoin. So that's it for this week. I do encourage people to go check out the blog, read it for yourself, see some of the details we put in there about value investing. I do think that we'll probably won't be talking about the Middle East as a market driver past next week or the week after, and we'll see what the next new market driver is. But for the meantime, volatility for the sake of volatility generally leads to some pretty good events and trading opportunities, and we'll be scoping those out over the next few weeks here. So thanks, everybody. Appreciate you listening. We'll talk to you next week.